All right, let's start. Thank you very much for joining to another webinar of Into the Block webinar, which we try to discuss some of the current topics in the digital asset space. Today, we're gonna focus on a topic that is very close to our heart here in ITV, that is related to alpha in DeFi, as you guys know. Where we do a lot of work on quantitative strategies in DeFi with large institutions, and a lot of what you're gonna see today is based on those practical lessons. As a matter of logistics, if you have any questions during the webinar, feel free to interrupt or use a Q&A. I'm going to stop multiple times during the presentation to take questions, and we try to keep this to 30 minutes and go relatively fast. So before the agenda is going to be super simple. We're going to talk about the nature of alpha in the current DeFi market, opportunities and practical trades that you can execute today. And then how do we think DeFi should evolve in the next few years in order to capture more, let's say, mind share, particularly on the institutional side? Before we start, we're gonna do our usual update about Into the Block, but this update is very special because a few days ago we launched Into the Block Perspective, which I like to call it our most comprehensive or most complete release of the Into the Block analytics platform. So Perspective is a release that essentially allows our research team to author dashboards about a specific topic. So it's very thematic. You can find dashboards about stablecoins, about layer twos, about a specific ecosystems, and publish it to production without involvement of our engineering team. So it's completely self-service. What that means is that every few days you find something new, something fresh, and it's extremely detailed. So it's we've been told by different parties that it's probably one of the best analytics or the best analytics release in the market because of the depth and also because of the speed and how current it is. So you should check it out. There is about a dozen perspectives in the platform today that cover topics like ecosystems like Arbitrum or Base, or topics like Bitcoin whales or layer twos or layer ones ecosystem. So it's very, very interesting, and each perspective gives you a textual description of what it is and a bunch of charts that you can use to evaluate a specific topic. So as an investor, as a trader, you can just go there and do your own research. It's very thematic, it's very current, and again, every few days you find something new. So it's not a static release by any stretch. In addition to that, we're gearing up towards the release of the DeFi Risk Radar platform. We're gonna launch with a lot of DeFi protocols as partners, so it's quite exciting. We just wanted to take a few weeks between the release of Perspective and the release of Risk Radar. And then other updates, we have deployed quite a few new strategies in our institutional smart yield platform. We're about to add Tron Analytics to our analytics platform and new protocols to the Risk Radar. So that's probably enough for the Into the Block update. So what we're gonna cover today is the nature of alpha in DeFi and some of the current opportunities. So some of the key things that we're gonna discuss is topics like, is there alpha in DeFi today? So is DeFi gone? Can I find opportunities? Do we need to wait for the bull market? What are the main structural changes that have happened in the last 12 to 18 months, and what trades are working today? So these are going to be some of the key takeaways of this presentation, and hopefully we can go quite deeper into a bunch of those. So when you think about the nature of alpha in DeFi, it has certainly changed in the last year and a half, and particularly in the way that is materialized today with respect to how it's materialized in traditional markets. So in a normal financial market, not to say that DeFi is not normal, but in traditional financial markets, alpha is captured fundamentally by active strategies that try to beat market indices and exploit market inefficiencies, right? Asymmetries between different financial instruments. So there are different categories of returns in traditional markets. So the most passive investor, typically you're seeing this term beta that is fundamentally based on index, right? On aggregated returns across different categories like bonds or specific categories of equities. Some quantitative funds focus on this idea of a smart beta, enhanced beta, alternative beta, that is a small premium on top of traditional beta. There are famous funds like AQR. So the entire school of factor trading, factor investing comes from this, from doing a smart beta. But then true alpha is opportunities that beat those standard beta benchmark, which are, could be as simple as index, like the S&P 500, or more sophisticated things like a factor portfolio. Now, in the case of DeFi, what happened was that alpha in DeFi got too easy, right? Because there was a disproportional amount of incentive and a disproportional amount of opportunities for leverage. So alpha in DeFi looked like something like this, right? You would deploy in a DeFi pool and you will get a ton of yield. And a lot of people thought that, okay, that's how trading in DeFi should be, right? And because the returns were so massive, those were really alpha returns because they were beating the standard benchmark. Let's say that a benchmark for Ethereum is a staking yield, or a benchmark for a stable coins is a US Treasury bill. Then DeFi pools were returning disproportionately above those numbers by just depositing in a pool, and that's it. So the market got accustomed to this idea that something as simplistic as this was a strategy, but the reality is that doesn't scale, like we have learned in recent months. So typically, when the whole easy yields in DeFi was a phenomenon that was driven by this idea that protocols needed to solve the cold start problem, right? So they needed to deploy incentive in order to achieve a specific market share, a specific traction. But if they never got to the point of getting utility on that protocol, then those yields would dissipate over time. So when you think about this idea of incentive-driven yields, it's a little bit of a fallacy, because true alpha in financial markets come from market asymmetries. It doesn't come from any arbitrary incentive. Then those yields that you see in DeFi protocols, they're not risk-adjusted yields, because the definition of what is risk, on a quantitative definition of risk, it hasn't been established. So typically when you look at returns on equity, you do risk-adjusted returns, and typically the canonical measure for risk is volatility. In DeFi, there is not such a thing, right? So you might be looking at a 20% return, but when you evaluate the risk associated with that, is not that much. And ultimately, sustainable yields need to be associated with some level of utility, right? So it should be a financial instrument that is being used in traditional markets. It could be as simple as trading activity, but it has to have something else that just incentive. So those three components are sort of the three main vectors that challenge this idea that incentive-driven yields are sustainable. So when you think about alpha in DeFi, there are two main areas that we should think about. One is the capital life cycle of DeFi. This is a framework that sort of works for us and that we use all the time. And the second one is risk. When you think about the capital life cycle, this is more or less how the life cycle of a traditional protocol will look like. Let's say a protocol start, and then it has to gain certain level of liquidity adoption. So it deploys incentives to attract that liquidity. If that liquidity is enough to achieve mainstream utility, then you're good, right? So then that's a case of Compound or Aave or Curve, that they found a purpose in the market and they're being used even when the yields are not very good. So then those protocols achieve established total value lock, and then they contribute to yields or to alpha in the entire ecosystem. There is all sorts of opportunities that emerge by combining those protocols with other things. And the native yields in the protocols will naturally decay, right? The yields in Compound a couple of years ago is not what they are today. Now, if the protocol does not achieve mainstream utility, which happens all the time, then they need to deploy more incentive. They need to do this loop multiple times, and that TVL is really mercenary, right? So it will leave chasing other yields, so the TVL of the protocol will decay and the yields will decay, and then you get into this vicious cycle that some protocols need to iterate multiple times until they're able to break through. So why is this important? Because when you're chasing a yield, when you're looking at alpha in a market, understanding the nature of the capital life cycle in the protocol that you're deploying is super important. The second component is the relationship between the alpha that you see and the risk. And I like this chart a lot. So the way we think about this is that at the beginning of DeFi, during the DeFi summer, alpha was really easy, right, to get, and the risk in protocols is very complex, right? Because you could deploy in a pool in, let's say, an AMM like Curve and get 15-20%, but then a slippage or a whale will exit and will kill your trade. So risk was very complex. Then we're going into an area in which alpha is more complex. You need to work for it, and risk is complex. And that's where we're at today, right? Getting returns is hard, and managing risk is super hard. Eventually, we want to get to the point in which getting returns is still hard, because that's the way financial markets work, but risk should become easier, because ideally, right, in a few years, we're not going to get this amount of hacks and inefficiencies in the market, right? I mean, we hope that protocols are going to get better at what they do. If not, we should all go do something else. So where does that put us today? Well, it's not a very nice environment in DeFi in general, just like it's not a good environment in crypto in general. So the TVL has decayed to about a 2-year low. It is highly concentrated. So in a lot of markets, the TVL is highly concentrated on a number of players. There is a ton of asymmetries. As a byproduct of many things, market makers are not as active as they used to be. So there is a lot of asymmetries in the market, which leads to all sorts of interesting trades. Then risk has taken a very important connotation, because some of the largest protocols in the market have been exploited. And then things like high interest rates are sort of conspiring against the adoption of DeFi, because then why would I go into stablecoin strategy when I have a risk-free rate above 5%? So all these things is what we're dealing with today, and yet there is plenty of opportunities. Among other things, because all the easy opportunists sort of traders left, right? And there is more. The market is very asymmetric, very inefficient, will lead to a lot of opportunity, and more of the people operating right now are, stronger believers, more talented from the trading standpoint. So one thing that I like about this environment is the fact that the ones that are participating on are true believers in DeFi. So I don't think we should be in DeFi because the yields are high. We should be in DeFi because as a parallel financial system to traditional markets is the one trend in crypto that encompasses the true ethos of Bitcoin and all that. And I said that in every presentation about this topic. DeFi is not only decentralized, but is a meritocracy. anybody has access to financial services that are traditionally very expensive. It's programmable, it's composable. So all those things are the merits of DeFi that should attract institutions and should attract traders and should attract investors. So it is not only the high yields, that's just a byproduct of the structure of the market. So there are quite a bit of opportunities in the current market, in the current DeFi market, despite of what you might hear out there. So when we think about the principles that are driving those opportunities, well, the market dislocations have created a ton of asymmetries between the structure of the centralized exchange sub-market and the structure of DeFi, which means there is a ton of arbitrage and things like that you can do. Most alpha that you discovered today is combinations of things. So the easy alpha, although there are still pockets of those, but this idea that I deploy here and I'm done, more is harder to come around. And but there's some of those, so you still get some of those traditional opportunities in DeFi, particularly nascent ecosystems or things like Arbitrum that are deploying new incentive programs. So let's start with a number of trades that I want to show you that is not the specific trade down to the algorithm, but more about the general idea of what you can do and how to monetize those. And those are things that we're doing or evaluating, and the opportunities are quite real. So the one trade that has been around for a while is this CeFi DeFi arbitrage. The logic here, what this trade is so attractive, is a trade for this market, right? Because the asymmetries between CeFi and DeFi today are very large compared to what they were, let's say, in 2021. So a way to architect this trade is very simple. So you have a pool of centralized exchanges. You can have something that we call a quoting agent that essentially looks at a specific asset and comes up with ranges in which those prices make sense to buy or sell, like a mini order book, if you like. It will send that to a DeFi, a smart contract or an algorithm that can actually execute on DeFi that will scan across different dexes for looking. Let's say that I tell you, you can buy Bitcoin between 33,000 something and 34,000 X with this amount of this volume, and you look at the specific pools in AMMs, particularly in UniV3 type AMMs that are very active, about which ones satisfy that criteria. Then we have this component called the trade executor that you say, okay, go buy this or set that, it executes that trade and send it back, and the inverse CeFi trade gets executed. And just that dumb trade sort of works today. And you can think of many variations of this. You can think about the inverse trade. You do the price discovery in DeFi and execute in CeFi. That one is a little bit harder because things like Binance or OKX sort of drive the price discovery side, but it's still viable. You can think about variations of this with perpetual swaps and things like GMX or Quenta. So there is all sorts of variations of this trade that kind of work. Another classic that is now working quite a bit is MEV arbitrage. This is actually one of the first trades that we ever did in DeFi, and it worked for a while until it didn't, and now it works. It works again. The asymmetry here, what has made this trade come back is sort of the lack of market making efficiency in the current space. So there is a lot of gaps in DeFi protocols right now that you can find a lot of arbitrage opportunities between different protocols. This trade is kind of viable, more viable in non-Ethereum blockchains other than Ethereum, because in Ethereum with frameworks like Flashbots is more competitive, but in other blockchains there is no such an equivalent to Flashbots that is widely adopted. So the MEV race is is way more interesting. By the way, if somebody has a question or that, use a Q&A panel. We're monitoring that. So the way this trade works is you will monitor the mempool with something like an MEV searcher, stimulate those transactions, and if those transactions commit, what is the state of these protocols, statistically speaking, and then do a scan across different dexes for trades that will arbitrage with that state that you arrive. So you will look at the mempool, simulate the trade, and say, well, this pool in Uniswap should end up in this stage. What is the current stage? What trades should I execute before these transactions commit, execute those, and then if you do it at a scale and you play a little bit with the law of large numbers, then that generates interesting alpha. So another trade that we think is quite interesting, again, looking at the whole asymmetries between CeFi and DeFi, it turns out that these days borrowing via lending protocols in DeFi is not only cheaper, but it's always been more efficient than through a lending desk. And there is market making opportunities across the space that are quite lucrative, particularly with stable coins. And because there are no native yields in DeFi for things like Bitcoin that actually work, that are attractive, there is a lot of parties that are sitting on a lot of Bitcoin. So a normal trade here could be something like a market maker deposits an asset, let's say Bitcoin, in a specific vault and go to lending protocols and swap for USDC DAI, go does its market making thing, and then deploys an extra amount of capital to protect that principal, that Bitcoin. And then there is an algorithm that if the price of Bitcoin drops, will remove part of this capital to cover the collateral so the position doesn't get liquidated. So if I'm sitting on 10, 20 million in Bitcoin and I cannot earn any yields on those, I can actually borrow against those. But the problem is the risk of liquidation is very high. So the problem is, how do we mitigate that? Okay, I deploy another thing, let's say ETH, that I can put to work with a specific yield. And if there is a risk of liquidation, I will use that yield, that ETH, to cover the loan. And it's a more efficient way. And then if you're borrowing at 4% and your market making strategy with USDC is returning 12%, by the time you repay the loan, you're making a healthy yield in Bitcoin, which is nearly impossible to do today by just deploying in a single-sided pool or things like that. So another strategy that we like here is what we call augmented lending strategy. So because of the asymmetries in the market today, a lot of pools in AMMs are returning a lot, but they also very sensitive to impermanent loss. So there is a trade that we think is quite effective, in which you can actually supply liquidity to a market neutral lending strategy, let's say a protocol like Aave, right? And you can use some leverage or what have you. And let's say that we're doing this trade with ETH, and I can do a leverage trade and I'm returning 5-6% market neutral. But you take a portion of that, let's say that we're deploying 10 million, and we put 8 million in this market neutral leg, and we take 2 million and deploy it into what we call a yield augmenter that essentially distributes this to a number of AMM opportunities with certain logic at 20, 30, 15%. Some of those are going to fail. Some of those are going to work. If the composition is good enough, you should be earning a return above the 5-6% that you will earn on your 10 million. And then you can set up a stop losses on this thing. And then if you hit those stop losses, you revert back to the market neutral opportunity. So the way to think about this is, in the example of ETH, let's say with 10 million, if you only did this leg, you could earn, let's say 5-6%. But then if you did this whole thing, you could earn something between 5 to 8 or 5 to 9 or things like that. So there is a scenario in which you earn less, but in aggregate should actually, if this distribution is well put together, it should actually work. So we call that augmented lending strategy, and it sort of works. And then another trade that is quite interesting in this market condition is what we call basis augmented AMMs. Why is this interesting? Because give or take, the basis trade in centralized exchanges has been working with some regularity, so you can earn, 3, 4, 5% on a specific asset. But then what if you can actually complement that with something that you can do on DeFi? So a variation of this is that you, let's say, take some Bitcoin, put a basis trade that is giving you something, and on a perpetual contract, and take the spot of that basis trade and deploy it into a number of yield strategies with AMMs, and then you can be doing 8-9% on the DeFi side, 3-4% on the CeFi side, and that one acts almost as a hedge to the DeFi side, because you're already putting the trade and deploying the spot. So is obviously that this trade requires that the basis is working, but the basis has been, for many assets, has been working quite a bit in the current market conditions. And then there are other variations of the strategy. So there are new ecosystems that have launched, like Base, Arbitrum is about to deploy new incentives. So obviously you have the classic opportunities remain in those ecosystems. There is also some interesting opportunities with derivative. That is one of the markets that is growing quite a bit in DeFi. And then we have this sort of newcomer wave of real world assets, particularly tokenized US treasuries, which seem to create all sorts of interesting opportunities between TradFi and DeFi. In that sense, in the sense that, these are tokenized treasuries that trade 24/7 versus traditional markets and things like that. So there is some interesting opportunities there that we have been exploring. So, however, all these opportunities exist in the current market and many more. And it might get us through for a while, but if DeFi still has some foundational issues that I think need to be addressed in order to reach the next level of the next level of growth. So there's some primitives that are missing. So no financial market works without credit, and all credit in DeFi is over collateralized today, which is just fundamentally hard to scale. So figuring out ways to do under collateralized credit is super important. We dabble with some ideas in the space, and it turns out the market is not there for that, but some more people should try. Then both AMMs and lending protocols are very inefficient. So traditional AMMs are super capital efficient. So from the capital formation standpoint, they're great for automation, but very bad compared to order books and things like that. So more hybrid protocols that combine order books and AMMs are interesting. Bridges have to get better, right? Like it's every month one of these blows up. We need better risk management. We're working very hard in that area. Also, the maximum expression of risk management is insurance. So if somebody figures out a good insurance model for DeFi that is credible at the institutional level, I think that could do wonders for the space. Deals need to become more organic. They need to be representations of utility, representations of activity in real world assets and things like that. And that goes with the utility. At some point, we're going to have bridges between traditional finance vehicles, stock bonds, and DeFi. There's still primitives that are missing. So things like margin trading are hard. If you assume that credit is a primitive, you can put it in that category. Nobody knows what is going to happen with regulation in this space, but hopefully there is a path to a thoughtful way to do KYC AML in DeFi protocols, something that doesn't hurt the space. I think Vitalik has published a couple of ideas in that area that are quite interesting, and there are a few more of these building blocks. So that's what I wanted to cover today. So in general, the conditions of DeFi have completely changed relative. We shouldn't be thinking about DeFi through the lens of 2021, but there are plenty of opportunities. So this idea that there are no returns in DeFi is complete nonsense. But most opportunities are based on, like in normal markets, right, on asymmetries between different financial instruments. And then to get to the next phase, we need a little bit more. We need more building blocks. I would like to go to Q&A, but the next webinar in November 22nd, or head of research is going to talk about new trends in DeFi, the stuff that we're seeing with micro primitive, modular, blockchain, risk taking, like all the things that are coming down the pipe that are probably going to shape the next wave of the ecosystem. Our head of research, Lucas Otomoro, is going to be covering that topic. That's all I have for today. If you have any questions, please, let's go to Q&A. You have the link to the next webinar there, so please sign up. While you're at it, you should check out our perspective release. It's really good. If you have any specific questions, you can drop me an email at jr@intotheblog.io, or I don't know if there is anything in the Q&A now that we should look at. I don't see any questions. Oh, Todd said, can you define the type of asymmetries and which provide yield? Yeah, many, right? Like I mentioned, the CeFi DeFi arbitrage is a classic, right? So particularly when you go outside the top 10 tokens by market cap, because market makers are not very active, there is a lot of asymmetries. The same with cross-chain arbitrage. I think there is quite a bit there on that. Another question is if real-world asset tokens are available as collateral in some DeFi platforms. Yes, there are lending markets that are open in tokenized US treasuries. So that's their pools, their AMMs are supported. I'm not 100% sure on lending market, but considering that Rob Leshner from Compound is working on this, I think it's not going to be long. Tony is asking, where can I learn more about tokenized US treasuries? I mean, there are different projects that you should look at. There is one that we particularly like called Mountain Protocol that just came out with their seed round. Matrix Board has a pooling curve that is running their tokenized US treasuries against CRB-USD. I think it is. As I said, Rob Leshner, the founder of Compound, is working in an initiative in this area. There is Ondo Finance, and they're very good at what they do. So there are different projects that you should that you can look at it that have different variations of tokenized US treasuries. I don't see any more questions. So I think we're going to wrap it up for today. Thank you very much for joining. Sign up for the next webinar. Check out the perspective release. And I hope to see you in 3 weeks.